Hi, I'm David Lin, host of the David Lin Report. Starting today, in addition to my daily news interviews with financial experts, I'm going to run a nightly news recap program where I report on the biggest market stories of the day that you may have missed. Tune in every weeknight, Eastern Time, to get the most important news of the day delivered straight to you here on my channel. You can also subscribe to my free newsletter on Substack for more information. Link down below in the description. Today's top stories: Nvidia reached new market highs, Trump announced new tariffs on copper in pharmaceuticals, mortgage applications jumped to a 2-year high as buyers return to the housing market, and the Federal Reserve released minutes to its June meeting, which we'll summarize. U.S. markets rose Wednesday as Nvidia hit a new all-time high, briefly becoming the world's first $4 trillion company. Nvidia shares rose 2.8% on the day to $164.42, solidifying the chipmaker's position as the undisputed leader of the AI revolution. Since ChatGPT's debut in late November 2022, the Nasdaq has surged roughly 90%, with Nvidia alone accounting for 7.5% of the S&P 500's total value. This milestone arrived just as Wall Street's biggest names raised their year-end targets, with Goldman Sachs and Bank of America both citing corporate resilience in the face of policy uncertainty as a big reason for why they continue to be bullish on equity markets. Meanwhile, President Trump's surprise 50% copper tariff sent the metal soaring 13%, its largest single-day gain since 1989, to close at $5.69 per pound. In the morning, the S&P 500 rose 0.2%. In comparison, the Nasdaq climbed 0.4%, suggesting that investors are betting artificial intelligence momentum can outpace tariff headwinds. Commerce Secretary Howard Lutnick confirmed the duties would likely take effect by August 1st, giving American manufacturers less than a month to brace for what could amount to $5,000 per metric ton premium over global prices in copper. The copper announcement formed part of a broader tariff offensive that's kept markets on edge throughout the week. Trump unveiled new duty rates for 6 additional countries Wednesday, including 30% levies on Algeria, Libya, and Iraq, while threatening pharmaceutical imports with tariffs as high as 200%, though he suggested drug makers could have about a year and a half to relocate production to American soil. These sector-specific measures operate under different legal authorities than the country-by-country tariffs, making them both more durable and more difficult for trading partners to negotiate around. The pharmaceutical industry immediately pushed back, warning that such levies would increase costs and potentially create drug shortages while diverting resources from research and development. This threat arrives as major drug makers, including Eli Lilly, Johnson & Johnson, and AbbVie, have already announced billions in new U.S. manufacturing investments. On the housing market, American home buyers, meanwhile, appear undeterred by the trade drama. Mortgage applications to purchase homes jumped 9.4% last week, reaching their highest level since early 2023 as the average 30-year rate dipped to 6.77%. The surge suggests that after months of waiting, buyers are finally responding to the combination of moderating prices and expanding inventory. However, industry veterans caution that 1 week does not make a trend. Here's what Ron Butler, principal mortgage broker at Butler Mortgage and host of the Angry Mortgage podcast, said on my show in regards to his mortgage rate outlook. Take a listen. Well, where do you think mortgage rates will be headed from here?
I see no particular reason for rates to drop substantially in the coming months. However, that said, Jerome Powell hasn't stopped talking about the possibility of cuts. It's not like he's taking cuts off the table. The dot plot calls for cuts still for the balance of the year at some point during the year. There's a case to be made that inflation is not as sticky or as certain or as definitive as the Fed has sometimes described it. So we may actually see some rate cuts. We may see some lower treasury yields, but that may not be till the end of the year, and that's not very good. That's going to be another sluggish 2 quarters.
Corporate credit markets are painting an equally optimistic picture. High-yield bond spreads have compressed to levels not seen since before the pandemic, with the premium over treasuries falling to just 2.88 percentage points. This remarkable tightening has occurred despite, or perhaps because of, the tariff uncertainty, as investors bet that domestic-focused companies will benefit from protectionist policies while the Federal Reserve maintains its supportive stance. Vietnam emerged as the clearest winner on Wednesday in the great reshuffling of global supply chains. The 20% tariff rate negotiated with Washington positions the Southeast Asian nation favorably against regional competitors facing levies of 25% or higher, potentially accelerating the migration of manufacturing capacity from China to Vietnam. Vietnamese stocks have rallied to three-year highs as investors calculate that even with Trump's 40% penalty on transshipped goods, the country remains an attractive production base for companies seeking to serve American consumers. However, not all economic indicators are flashing green. The Bureau of Labor Statistics' latest employment data revealed troubling disparities. Bloomberg reported this morning that the black unemployment rate jumped to 6.8%, even as overall joblessness fell to 4.1%. The employment population ratio for black Americans has been sliding for more than a year, potentially signaling broader labor market weakness that has yet to surface in headline numbers. Most alarming, though, is the 6.1 percentage point decline in employment rates for black Americans aged 20 to 24, a collapse so severe it raises questions about data quality even as it demands policy attention. China's economic struggles provided another cautionary note. Data released yesterday shows producer prices dropped 3.6% year over year in June, the steepest decline in nearly 2 years, as vicious price wars spread throughout an economy already grappling with weak consumer demand. While Chinese export growth has shown surprising resilience, the deflationary spiral in domestic markets suggests that Beijing's ability to absorb American trade pressures may be more limited than it appears. The technology sector today witnessed drama unfold as Linda Yaccarino stepped down as CEO of X after 2 years of attempting to lead Elon Musk's social media platform. Her departure, which came just 1 day after the company's Grok chatbot began generating anti-Semitic content, highlights the challenges facing AI deployment even as investors pour billions into the sector still. The timing proved particularly awkward given Musk's feud with President Donald Trump, and this comes as reports indicate Meta's Mark Zuckerberg offered $100 million in bonuses to OpenAI employees in an attempt to poach them. Finally, Federal Reserve minutes released this afternoon revealed a committee deeply divided over inflation risks, with most policymakers warning that tariffs could have persistent effects, quote unquote, on prices rather than the one-time impact a minority expected. The records show that 10 of 19 officials anticipated at least 2 rate cuts this year, while 7 projected no cuts at all in 2025, a split that underscores how trade policy uncertainty has complicated the central bank's calculations. Stay tuned for tomorrow's reports, and once again, subscribe to my Substack, link down below for more updates.